Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for watching the channel. I greatly appreciate all the comments and subscribers. Thank you very much. This week up, we're going to look at PNC Financial, the medium-sized financial institution. Behind me is their 10K, filed as of December 31st, 2020. Let's rip through this thing and figure out what they make in terms of revenue, net income, what their book value is, and how much we think we can own the stock if we buy it today and hold it for a decade. Ready? Let's get to work. Okay, behind me is their assets. But before we review this, let's review the top three things we look for when we're reviewing a bank stock. Number one is revenue. We need revenue to be growing. Number two is net income. We also want net income to grow. And number three, book value. We want price to book to be a relative value such that our return beats the market. That's what we're looking for. Not too expensive, not too cheap, but a reasonable price given its growth rate. Let's go through it and see what we get. Total assets, $305 billion of total assets has grown to $466 billion in assets. That's a 5.5% annualized growth rate, which is a very good growth rate for a company this size. If I subtract out goodwill, intangibles, total liabilities, and preferred stock, all the stuff that we don't own as common stock, if I subtract all this from here, I get net book value. Net book value is really what we're buying when we buy a bank. And net book value in this case is growing at 5% a year at $27 billion to $40 billion. Excellent. That's growing in line with assets. It means they're not over leveraging themselves. That's a good, solid start. I like that. Now let's take a look at book value per share. Has been growing, almost doubling over this period of time. Market cap as well, doubled, $30 billion to $63 billion. As a result, you've got a price to book ratio of 1.6 right now, roughly. Historical average is 1.7 over this period of time. So it seems like it's right around this average. You're not going to get a big upside. Hopefully you don't get a big downside in terms of this number. That seems to be a fair value for this stock. Now we'll figure out if buying it at a fair value will yield an outsized return. Behind me is the revenue and net income for PNC Financial. Revenue $14 billion to $14 billion. That's flat, but there's a COVID caveat, right, where they had to write down income. So you've got $14.5 to $16 billion. Very weak growth, but it is growing. Technically, it's growing. It's positive. Here, I've made an adjustment for a loan portfolio write-down, $3.2 billion that they've had to write down. That's why this number is lower. If I added that back, you'd be in that 16 range. So I think this is weak growth. Revenue, net income growth, has been a bit stronger. $2.8 billion has grown to $4.2 billion. This number might be a little artificially low. It looks like you've got $4 billion here, $4 billion here, and you got a 4.2. So I think the net income growth is weak as well. And when I look at it in terms of averaging some of the numbers, I kind of average this, I average these two, and I get a 3% growth on the net income over time, which is kind of matching up to net book value. Again, weak, okay growth, revenue, revenue and net income. Let's see what they do with that and see if we forecast with this, what does it yield? Shares outstanding, they're definitely buying back shares. 529 million shares to 427. That's 100 million shares gone out of 520. That's more than, what, 25%? Of the shares outstanding they have purchased. That's a great sign. They have decent earnings growth. If you had bought the stock back a decade ago, you paid 1.1 times book value. It's now trading at 1.6. So you get the market multiple expansion of a half a turn of book value. That's nice. On top of earnings growth and fewer shares outstanding. So for me, this is the trifecta where you get a really, really sizable return, return on your equity position, almost tripling in value over that time because you hit the trifecta, which is great. Now the question is, going forward, is it going to do it again? I don't know. We'll have to see. I think buying it at an average of the price to book is going to keep it down. You really want to buy this stock when it's back closer to 1.1 to get the full impact of the market multiple expansion. Here, you can basically assume that earnings growth is going to continue and maybe some share buyback. Okay, so if I value this business, if I forecast it forward, what do? Well, you got book value. I can assume a 5% growth, which is what they've been doing historically. I'll give them that. $42 billion to $65 billion. I give an average market multiple 1.7 times. It's only up 0.1 turn, so you're really not getting much of market multiple expansion. If I leave shares outstanding flat, assuming they distributed all the free cash, they've got nothing left to buy back shares, that's $255 as a price target out 10 years for PNC Financial. So here, net income, what I'm doing is I'm taking the average of last couple years in 2018 and 19 because 2020 was a down year. I'm averaging 2018 and 19, and I'm growing that at 3% over time to give me a long-term forecast, kind of ballpark $12.25 out long-term. And then if I give a standard net income yield, 6.7 times, I get $180 as a long-term price target for PNC Financial. Now, when I look at the stock market, I can buy as much stock as I want at $190 a share. I've got two different forecasts, $180 and $255. I'm not sure which one is going to be right, if either. They could all be wrong. But I'll have it and say, conservatively, I've got $218 as a price target for this stock. If I plug this into my IRR calculation, I get $190 a share is what I can buy it for. I'm getting the net income over time, which is a nice yield. And I can sell the stock with a little bit of capital appreciation for $218 a share. All in all, that's an 8% IRR over time, basically 1.7 times my money. And I think what you're seeing here is the lack of a market multiple expansion. You're buying it at a price to book value, which is its average. And if I don't assume that that goes up, you're kind of just limited to the return on the net income yield that it's going to give me. You don't get too much price appreciation, especially if income itself is only growing at about 3% a year. You're not going to see a huge number. So I think for us at this channel, it's going to be a meh because there's not much I can do with it. It looks like it's going to underperform. I don't see a ton of upside here. Let's recap our three criteria. Number one, revenue is growing. Good job. Net income, yes, it's growing. Price to book, no. I don't think it's cheap enough to warrant the investment, and I would wait for it. How much does it need to be? Let's take a look. So if it's currently $190 a share and I'm getting an 8% IRR, if it goes up, obviously I'm not buying. But if it comes down, it's going to come down to $130 a share for us to get a good 50% premium to market. If the stock market, S&P 500 on average does 10%, I want to be marketably better than that to account for the cost for my capital or just my own personal goals. I want to be beating the market. So I'm not going to put money in the stock that doesn't have, at least with a conservative assumption, an opportunity to beat the market. If you like this type of review and you want to see and learn how to do this for yourself, check out my website, cashflowinvestingpro.com, where I give you templates and I teach you how to read financial statements, how to build a forecast, and how to build a portfolio of stocks that you can hold long-term that would give you a high probability of beating the market. And it's just running through assumptions like this, being super conservative and only putting cash out when you think the numbers warrant the risk. Once again, this is Rational Investing. My name is Cameron Stewart, CFA. Please hit the subscribe button, the like button. Throw a comment down there if you like it. Let me know what other stocks you want to see. This has been a bank series I've been doing for the last several weeks to show you kind of some of the key banks that I think I like, some that I don't. But let me know what else you'd like to see. I'm happy to review it. Again, Cameron Stewart from Rational Investing. Thank you. Bye-bye.